Gold is approaching a major liquidity zone right now, and smart money is actively preparing its next move. My primary focus for this explainer is a massive potential setup sitting just above key liquidity. But there's one critical condition that absolutely has to happen first. Most retail traders, they're looking at the exact wrong level today, which, let's be honest, is exactly how the trap gets set. I'm going to show you where institutions are actually targeting and how we can position ourselves before the algorithmic order flow shifts completely. Let's lay out the immediate trading blueprint. Our daily bias is broadly bearish, though we're currently in a bullish retracement. Stepping down to the H4, the bias is a clear bullish continuation. The primary setup we're hunting, an M15 discount retest. And our main drawn liquidity is the Buy Side Liquidity, BSL, resting up at 4354.30 and 4366.00. That's the expected outcome. Now let's break down exactly why smart money is targeting this area. Take a look at what happened down at the 41.1050 level. Price delivered a really aggressive sweep of major sell-side liquidity. It completely flushed out early buyers, grabbed those stops, and sparked a sharp, short-term institutional expansion higher. When you see displacement like this leaving behind clear support footprints, it's a dead giveaway. Institutional sponsorship has stepped in to hunt short stop parameters. But listen, technicals never exist in a vacuum, right? We've got major macro liquidity catalysts engineering volatility out there. Over in Asia, the Bank of Japan is projecting a hawkish move, raising rates to 1%. To put that into perspective, that is their highest rate since 1995. Meanwhile, the Reserve Bank of Australia is holding their cash rate steady at 4.35% because of economic slowdown fears. So why does this matter for gold? Because smart money is absolutely going to use this cross-asset volatility from the BOJ and RBA to clear internal intraday liquidity blocks. They do this right before transitioning into clean algorithmic displacement during the London and New York kill zones. Combine that macro picture with today's geopolitical order flow. We're seeing reports of a US-Iran peace framework being signed, which actually includes reopening the Strait of Hormuz within 30 days. Because of this, WTI crude is just hovering quietly around $80 a barrel, and the US dollar index is holding firm near 99.70 ahead of the Fed. This geopolitical shift is a big deal because it really caps short-term inflation fears. A stable macro backdrop like this, it's exactly what sets the stage for clean, engineered institutional displacement in gold, completely avoiding those chaotic, news-driven whipsaws. Which brings us straight into the H4 timeframe. Algorithmic order flow is drawing price right up into a massive, unmitigated H4 premium fair value gap. You can see it mapped out between 4342.90 and 4366.00. After that deep discount sweep we just looked at, price is expanding sharply upward to tap this premium array. This gap is basically acting as a magnetic draw. Institutions have to rebalance this inefficient pricing. Okay, so we know the destination, but how do we actually get on board? Let's drill down into the M15 dealing range. Right now, price is just sitting in consolidation near 4319.00. The dominant footprint is definitely bullish order flow, but this downward movement we're seeing, it's an engineered structural pullback. Institutions are deliberately repricing the asset into discount arrays to accumulate orders before the next leg higher. Remember the golden rule, we want to buy at a discount, never up at a premium. So let's look at the objective parameters for today's price action. We have two scenarios. Scenario 1 is our sell model. If we get a retest of the 43.25 to 43.35 mitigation block and we don't break structure, we can target the sell side liquidity below 43.10. But scenario 2, this is our highest probability buy model, and it's what we're really focusing on today. We're looking for an entry inside the M15 Fair Value Gap between 4295.80 and 4304.40. The target, that buy-side liquidity resting up at 4354.30. Let's map out that specific buy plan so you have a highly executable strategy. We are waiting patiently for price to drop into that entry zone, 4295.80 to 4304.40. Your stop loss needs to go securely below the structural swing low, right at 42.85. We lock in a risk-free position by taking 50% partials at 43.30. From there, our main targets trail up to 43.54 and ultimately that macro block at 43.66. And please stick to a strict maximum risk of 0.5%. But here's the problem. Right this second, the status is no trade. Smart money confirmation just hasn't appeared yet. If you're clicking buy while price is chopping around in consolidation, you are not hunting liquidity, you are providing it to the institutions. An entry is only valid when we see an M15 market structure shift or a strong bullish displacement candle closing above local highs, and that has to happen after a liquidity sweep into our discount zone. Patience always pays.
Now, while we sit patiently awaiting for a discount, I have a critical question for you. Where is the retail trap currently set? Like, where are all those retail trailing stops resting right now? The market is actually sending a massive warning signal on the H1 chart, right around the swing highs at 4354.30. This is the exact scenario most traders are completely ignoring. Retail short sellers have been aggressively trailing their stop losses down into this specific range, right above those highs. They see it as heavy resistance. But to smart money, those resting buy stops represent prime buy-side liquidity. That is the perfect fuel to absorb institutional long positions as price drives into the premium H4 fair value gap. We are looking at a classic false breakout trap in the making. However, when we're dealing with institutional logic, we always have an alternative market path. So this level becomes absolutely critical, 4285.00. That's our invalidation level. If we see a solid H1 or M15 candle body close beneath this price, the bullish continuation model is dead. It confirms the narrative has shifted, and smart money is actually engineering a deeper structural flush into the open H1 fair value gap lower down. If that happens, scratch the plan, cancel all buy limit orders immediately. Let's do a quick actionable recap for today's session. Step 1, wait for that M15 descent into our specific discount demand block. Again, that's 4295.80 to 4304.40. Step 2, confirm a clean liquidity sweep of the internal swing lows. Step 3, identify the M15 market structure shift or strong bullish displacement. And step 4, execute the plan with rigid 0.5% risk management. Stay sharp out there and do not get caught in the chop. If you enjoy this kind of institutional-style market analysis using ICT and smart money concepts, be sure to subscribe to ICT Market Theory. And if you'd like to trade alongside these specific setups, you can find the FXTM account link in the pinned comment below. But I want to leave you with a thought. As global interest rates keep diverging and geopolitical tensions simmer, are these algorithmic liquidity traps going to become the new normal for gold traders? Or is a much larger macro breakout just around the corner? Let me know what you think and keep your eyes on the charts.